Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Welcome to Provident Healthcare Partners podcast. My name is AJ Shekar. I'm a director with Provident. I also have a colleague on with me for today's episode, Kevin McDermott, who's an associate with our firm. On today's episode, we're going to be discussing healthcare M&A trends from the perspective of private equity investors. As many of our listeners know, private equity has been very active in terms of investing into platform companies in healthcare services in particular and leading consolidation trends across a number of different subspecialty verticals. And so what we'll touch on today is some of the recent trends we've been seeing within the space, especially the effect of COVID-19 on overall deal-making activity. There's been an obvious surge in deal activity recently as well, so we'll plan to cover some of those topics and just generally what future outlook is for PE investment in healthcare services more broadly. To add some context to our conversation, we're lucky to have a guest on for today. His name is Kyle Lattner, and he's a principal with WAD Capital. WAD Capital is a group that we know well and have done transactions with in the past, and so we're excited to have his perspectives on the line here. Kyle, welcome.
Hey, thanks, AJ. Really appreciate you guys inviting me and look forward to the conversation.
Absolutely. And so, Kyle, if you wouldn't mind, could you give our listeners a quick overview on your background and just a brief overview on WAD as well?
Yeah, happy to. I'll provide a brief intro here, and then we can take it wherever you'd like. I'm a principal with WAD Capital. I've been with the firm since 2013, and over the years, I've really spent all of my time focused on healthcare services investing here. And for those of you who don't know, WAD Capital, we're a growth-focused middle market private equity firm based in Chicago. Our firm's history dates back over 25 years now, and over this time, our approach to investing has remained focused on partnering with exceptional executives and management teams to build leading businesses across our focus industry sectors. And for us, that's really three different sectors, one being healthcare services, the other technology, and the third business services. All told, as a firm, we have about $3 billion of capital commitments across 5 institutional funds. And over the years, we've completed more than 325 growth-oriented investments, and that spans between both platform companies as well as add-on acquisitions. I think from as you think about us and what differentiates WAD Capital, we do tend to take a very disciplined and process-driven approach to investing that really leverages an ecosystem of resources across our firm. In addition to our investment team members and operating partners, we also have built out internal resources and team members across a variety of functions, including business intelligence and strategy, human capital and recruiting, business development, and portfolio operations. These ecosystem and functional resources, they not only help us develop our upfront investment theses and subsequently make our investments, but they also help our investments develop growth strategies and execute on those as partners moving forward with management teams. And I'd say that disciplined approach for us, it starts by really identifying and evaluating those sectors where we believe there's outsized growth opportunities and areas where our firm is well positioned to not only bring capital, but also some expertise and other resources to bear. We do look to partner with leading executives to invest in these targeted sectors, and then we'll bring the expertise in scaling growth companies. Often that's through multiple different growth levers as you think about M&A and consolidation, de novo openings in certain sectors, as well as a healthy degree of organic growth as well. And from an industry standpoint, healthcare services has always been a core focus of our firm and represents about half of our investment activity today. Historically, we've invested across many different healthcare services sectors, including physician practices, other multi-site clinician businesses, post-acute care, home health, behavioral health, lab, pharmacy, healthcare IT, and revenue cycle. And then I'm happy to, as we did in the conversation here, happy to also share, some of the more forward-looking areas where we are actively interested today as well.
That's great, Kyle. I think you bring some very interesting expertise and background just across healthcare services, but also some other aspects of the economy that even for us at Provident, we don't touch as much that could be really helpful to our listeners through our conversation here today. I think one of the items that, just comes up in conversation a lot recently, especially the dialogue that we've been having with investors, with CEOs, management teams, shareholders, is just kind of the general impact around, investment activity consolidation with this current COVID-19 landscape that we're in and hopefully emerging out of. So would love to hear kind of your perspective on how COVID has impacted, let's say, the way WAD or maybe even other PE groups that you've interacted with and how they evaluate investment opportunities. And I'll also let kind of Kevin opine on that from our side, just from the perspective of an investment banker as well.
Yeah, absolutely. Happy to touch on that. As we all went into the pandemic in the early to mid part of last year, the deal-making environment took a screeching halt, and for good reason. And I think what we've seen over the last call it 6, 9, 12 months here as the recovery unfolded is really an appetite for investors to get back into the deal-making environment and for companies and sellers to look to ultimately transact. And I'd say that private equity community today, I think, largely evaluates opportunities consistent with how they evaluated them pre-COVID. And they are taking the view in a large part that it is a non-recurring event in the larger market ecosystem. And, that comment's not to dismiss the impact of the pandemic. The impact was severe, and it certainly had an impact on many lives. It had an impact on business models. It had an impact on company margins. But for the most part, I think private equity recognizes that it was an extraordinary event and certainly is not indicative of a business's baseline performance today. There are certain exceptions, though, and we've come across some sectors that have just fundamentally changed as a result of the COVID pandemic, particularly those markets where technology development accelerated or, the shift to telehealth and certain verticals really took hold. We've also seen instances where, certain companies within our portfolio or ones we're evaluating for new investment have actually come out stronger and ahead as a result of, the sustainable operational changes that they've made, whether that, be from an enhanced labor model or implementation of technology and systems that have improved operational efficiencies at the end of the day.
So on the opposite side of the aisle, from the banker perspective, we went through a wave or a roller coaster of sort of cycles from a business development standpoint and the way transactions are structured and how you're closing deals over the past 12 months, let's call it. And as Kyle noted previously in his answer, deal activity came to a screeching halt in sort of the March timeline of 2020 last year, and for a good reason. And then for about April and May, things were quite quiet and slow, and transactions that were getting done or closed had a high degree of structure involved as well. But towards Q3 and Q4 of last year, deal activity picked up significantly. And I think as private equity remained on the sideline for most of 2020, they had a lot of capital to deploy in the latter half of the year and needed to do so quickly. So from a Provident and investment banker standpoint, a lot of our business development activities to the first half of 2020 came to a halt. A lot of the transactions we were working on is a lot of client maintenance and transaction maintenance. So we really had a gap in our business development pipeline towards the beginning of this year. But as valuations have remained very robust, we've been very active on the business development side now. We've been signing up clients at a record pace. I believe in Q1 alone this year, Provident was able to sign up 12 new clients in healthcare services space. And I think that's reflective of the strong seller environment right now and how competitive valuations are. And as Kyle noted, there are some areas where they're being PE, reflecting opportunities like they were pre-COVID. So we're seeing really strong activity bounce back and have a pretty positive outlook for the rest of this year.
Yeah, I think one interesting element that both of you touched on was that there was, definitely a settling effect throughout probably Q3, Q4 of 2020 as a lot of businesses just got used to the new normal in terms of how business could be conducted in this COVID environment. A lot of efficiencies that, just had to be enacted, but ultimately could be sustainable long term. And so for us, it seemed to be, and Kyle, feel free to chime in, that, those companies that were able to, let's say, adjust to COVID operating protocols and just continue to see opportunity from a growth standpoint, likely were, those groups that were more highly sought after, valued higher than some of their peers that weren't able to adjust as much or, let's say, had extended difficulties from a COVID standpoint. So, maybe from your perspective, Kevin, is that valuation environment indicative of what you've been seeing in the market? And Kyle, would love to hear your perspective on, what's been causing valuations to, let's say, remain at pre-COVID levels, or perhaps instances where it may have been increased from pre-COVID.
Yeah, I think there are a number of factors at play. I think, one, even within healthcare services and physician services, more specifically, which we focus on, you see the retail healthcare industry type practices like dental and dermatology took a larger hit because those were largely seen as more elective procedures, whereas something like orthopedics or pain management, those were considered essential services to folks and their day-to-day lives and be able to improve patients' lives and care. So those are the type of sectors that remain pretty resilient and bounce back quicker to pre-COVID volumes than, say, dermatology or dental did, which in some parts of the country, depending on where there are restrictions, they still might be at 80 or 90% pre-COVID levels, where a lot of our pain management clients or orthopedics clients, they're at 90% plus or nearly or above pre-COVID levels. So I think, if depending on the sector you're in, part of the country where there are pockets that are still slightly less restrictive than others, you could yield a better valuation than some other sectors or pockets of the country at the moment.
Yeah, I'll chime in too. AJ, you raised a really good point around, the companies who were able to sustain through the pandemic and sort of grow out of it. COVID really did shine a light on those businesses who were, I'd say, fundamentally strong and able to navigate the pandemic. And, it was everything from managing liquidity on a daily, hourly basis within the practices to adjusting operating processes, ultimately bringing providers back to work, developing strategies to stimulate additional patient demand. And I think, that's a fundamental testament to the strong management teams and cultures of those companies who were able to sustain and then rebound coming out of the pandemic. And there are premium valuations being ascribed to those companies that have navigated COVID in that manner. I think what you're seeing for the industry and market in general is really a combination of pent-up demand as it relates to valuation levels. I think that's both from, the equity side of the equation as well as the debt capital market side. Investors have a desire to deploy capital, and the robust PE interest combined with heightened levels of debt availability, you're seeing an increased competition for, those quality businesses that are trading for swelled valuation multiples today.
And Kyle, you bring up something interesting, which leads into a question I had, which I'm sure that the listeners are thinking through. There's obviously been a lot of competition for the quality assets in the market that, withstood COVID, had good management teams, good protocols, were able to see growth where others may not have been able to. Is that one of the challenges as well in today's PE environment in terms of the swelling valuation multiples, the competition you're seeing? And, maybe just to follow on to that, what other difficulties are you finding as a principal investor these days compared to, let's say, a year ago, 2 years ago, et cetera?
Yeah, I think that's absolutely one of the biggest challenges is just the increased competition across, certain markets. And, the increased competition are for the quality assets. And if an investment firm doesn't have a solid thesis and an angle on an investment opportunity, it does become really difficult to have the conviction to pay, market clearing prices that are required for some of these businesses. So, I think that's one thing that has guided us as an investment firm, Waud Capital, is just our process-driven approach around, our sector thesis work and developing the conviction behind those markets and ensuring, when we do talk to management teams of companies and sellers, as well as investment bankers like Provident, that we're best represented on our end and able to, participate and pursue assets in a competitive manner. I'd say the other challenging factor, which we touched on a little bit earlier, just I think has to do with assessing the true run rate and sustainable performance of some of these companies. And that particularly comes to hold in certain markets. There are still lingering COVID restrictions. There are still operating model inefficiencies hanging around from the COVID pandemic. There are questions around pent-up demand in certain sectors. And, in those, and I'd say even more so in those businesses that are serving COVID patients or performing testing, around the COVID related services, there's questions around the true sustainability of those service offerings and how that's going to unfold for the balance of 2021 and beyond. But I think you'll see, hopefully here with the continued rollout of vaccinations and otherwise, just a continued recovery from some of the COVID impact in those certain markets that are still feeling the overhang.
Yeah, it's something that we're seeing a lot, these days as well, is being able to kind of truly parse out, COVID impact to financials, both for businesses that, let's say, took a significant downturn for, a few months in particular, versus others on the flip side. Urgent care comes to mind, where there was a huge influx of COVID testing revenues and profitability that may not necessarily be apparent when vaccines take hold across the vast majority of the U.S. economy. So can definitely see, some of the challenges that can come with thinking about, what does a truly normalized business from a COVID standpoint mean for the short term and the long term. Hopefully, as more of the economy gets back to normal, some of that will settle on a month-by-month basis. But just curious to hear how, you all at WAD have been structuring transactions in today's deal environment to, factor in, one, the competitive aspect that we're seeing in a lot of these deals, but second, thinking about how that's evolved as essentially more time has gone on to give visibility into what the new normal has been.
Yeah, I'd say, compared to 2020, which, 6 to 12 months ago now, there are certainly fewer deals today that are being closed or structured with unique structures, whether that be considerations around holdback payments or earnouts based on future performance that can be earned. To the extent there is still COVID impact in the historical earnings profile of a business, I think buyers in most circumstances are, willing to recognize COVID adjustments in that trailing period, or even start looking at a business on a recent run rate performance basis if the company has started to return to a normalized level. I think it ultimately gets back, though, to, the topic we were discussing earlier. I do think COVID pandemic is generally viewed as a non-recurring event in a larger market ecosystem. And there are certain sectors that, were harder hit than others, and certain sectors that are taking longer to recover than others, given certain dynamics that you described. I think each situation is going to be very opportunity specific around structure and how ultimately, PE firms are going to get to closing on some of these assets and deals that are still impacted by COVID. Yeah,
Kyle, I'm sure you're longing for the day where you don't have to look at COVID adjusted EBITDA anymore, right?
Yeah, absolutely.
Well, I think, it's a lot of good points and things that we've seen similarly, where it just requires a next kind of level of pre-market preparation, at least that we've seen in terms of, shareholder education around how, COVID performance will be treated as part of a deal process. Even a lot of discussions that we've had with folks like Kyle from the PE universe's standpoint around, what's kind of reasonable from a COVID adjustment perspective, what's not. And I think ultimately a lot of, shaking out that will occur over the next, call it, year or so, as some of the impacts of COVID are behind us. And certainly I think a much different landscape from what we've seen at Provident in terms of deal structuring today versus, let's say, where we were in the middle of 2020 or towards the end of 2020. And I think just maybe changing gears for a moment, and Kyle, this is something that you brought up earlier. Just curious to hear what sectors WAD is focusing on these days, and if that's been impacted to any degree by what we've seen through COVID, or just generally where you all are spending a lot of your time and attention these days.
Yeah, across our firm, we have several active areas of interest on the healthcare services and healthcare IT fronts, most of which fall into categories where we as a firm have historical investment experience, and we believe the services being provided, fall on the right side of the cost curve in the healthcare ecosystem. And, by that, I mean, these areas where we believe, there's an opportunity to improve quality of care provided and improve patient satisfaction, while also lowering costs for payers and other constituents more broadly across the healthcare ecosystem. Several specific areas of interest for us at the moment include risk-based primary care, other physician practice verticals where we have not yet invested to date as a firm. That includes urology, orthopedics, cardiology, women's health. Another broad area that we as a firm have interest in is medication-based services. That includes physician specialties like ENT, neurology, rheumatology, as well as specialized pharmacies. In addition to those areas, we also have interest in home health, tech-enabled staffing, electronic health records, and practice management software, as well as value-add distribution and logistics. And I'd say most of those areas of interest I just described, our firm has dedicated investment professional and ecosystem resources to really study the sectors, develop the investment theses, and ultimately pursue platform investments in partnership with leading executives or management teams in those areas.
Yeah, that's all great to hear, Kyle, and I think indicative of what conversations we have with a lot of our sell-side clients, where the question tends to revolve around, we're doing well, capital isn't, necessarily the primary motivation to do a transaction, but more so to align with someone who has some resources to bear outside of capital. And so it certainly seems like you all, take that approach of becoming sector-specific experts and trying to add value through some of your relationships and networking capabilities, et cetera. Kyle, I think a lot of the things that you mentioned, sectors that stand to benefit from secular trends in efficiency of healthcare services, being able to take advantage of value-based care, et cetera, it all kind of speaks to, a more cost-effective and efficient delivery of healthcare services, which I think in the minds of a lot of people, they may have misconceptions that PE is, interested in, let's say, maximizing reimbursement for every visit and not necessarily on some of these value-based care plays. I guess just generally, what maybe Kevin, you can start, and then Kyle, would love to hear your perspective. What are the typical misconceptions you may hear about PE partners and what their kind of motivations are, and how do you go about addressing those in those conversations as well?
Yeah, on the seller side, there's a lot of obviously upfront education that we have to do as a banker when trying to engage a client going forward. Oftentimes there's this big black box around private equity, and they look like just a job killer who slash, multiple seats at the management level in positions, and they lever up a company with copious amounts of debt that often puts the company in a very difficult situation down the road when they can't repay the debt, and then all of a sudden a lender takes over and it can get quite messy. For us, I think we, as a banker, we do a lot of education up front and telling them, they're looking to build the company and build off of the existing management team going forward to create this new company, because we always want to sell the idea that, no one knows your company better than the management team currently working there. And there's a big difference between someone like Kyle, who works with the existing management teams and their vision and strategy, and then keeps the clinical side of the business completely separate from what they do. So I think that's an important distinction that gets lost in a lot of education. I think also what's very important, as I touched on with key management team members and private equity, bolstering their vision and supporting them along the way, is that they really want key employees to stay on post-close and remain very active in this. Again, leaving the clinical decision-making in the hands of clinicians, but ultimately really acting as a catalyst and as a support system for a lot of existing goals and shareholder growth goals going forward.
Yeah, Kevin, I'll chime in here too. I think you hit the major ones on the head that we encounter for sure. One fundamental misconception is really just around the ultimate goals of a private equity investor, right? And how they intend to generate returns on investment. And there's many middle market private equity firms like Waud Capital who approach an investment in partnership with the goal of continuing to grow and build the platform. Whether that be expansion in existing markets and service lines, or diversifying into new markets or different offerings. The goal here, though, is really to create value by growing and building a stronger strategic enterprise at the end of the day. In order to do that, this requires further investments in people, further investments in resources and infrastructure to achieve that growth. And I think the misconception really arises when sellers may have developed a view that all private equity firms generate returns by actually eliminating the cost and cutting jobs and positions. And typically that is not the case with middle market investors who are focused in growth opportunities. The other misconception you touched on too, Kevin, comes down to patient care and clinical decision making. We are, as private equity investors, we are not in a position to dictate clinical care and would much rather leave that in the hands of the experts who are really our providers in the different businesses. One way we help ensure that that's the case is through establishing physician advisory committees at many of our companies. For example, at our dermatology platform, AP Derm, we established a physician advisory committee that is comprised of leading providers and physicians across our enterprise that really advise and ultimately make decisions regarding clinical operating practices. We know and recognize that the lifeblood and ultimate future of our clinician services investments comes from providing the highest quality patient care possible in an environment that fosters both patient and provider satisfaction.
Yeah, I think, the common themes we tend to hear from successful healthcare services investments, especially in the lower middle market where both of us play, are that, there's kind of a true partnership on both sides, that, there's the ability to gain some additional, obviously access to capital, but greater networking capabilities, best practices from other successful investments from the clinical side and the management team side and the sell side of these transactions, but also from the PE firm, there's a big, focus placed on aligning with the right team who has the vision that they can back, but also the solid clinical protocols and reputation that ultimately will create this good kind of symbiotic, relationship going forward. And I think you touched on an interesting point, Kyle, and Kevin as well, where, there's a sense around a lot of these investments that it's really kind of put together for long-term sustainability in terms of where healthcare is going, where the market is going, where the company is going, versus, let's say, some of the negative stories you may hear in other sectors of the economy or even upstream significantly, where it's more of a short-term play and a flip. This seems to be, and Kyle, correct me if I'm wrong, the pervading sentiment that the goal is to build kind of long-term sustainable businesses here.
Yeah, that's absolutely right, AJ. We're, in the investments in the markets, we're investing in those markets that present opportunities for significant growth going forward. And, our goal as an investor is to help enable that growth on a go-forward basis in a manner that sort of de-risks the execution of that growth and provides for really a successful and sustainable enterprise, coming out of the end of our investment horizon, which is, in the private equity world is anywhere from 3, 6, 7 years in length. And, the next buyer of the business and that platform will also, want to and invest behind an organization that is set up for continued and sustainable growth going forward beyond that time period.
Yeah, and I think it's interesting to note as well, just as of last year, the median US PE buyout holding period was almost 5.5 years, which was up nearly 25% since 2010, which was about 4.4 years. So I really think you see a huge commitment from private equity partnerships going forward and long-term growth and wanting to enter new markets and diversify and expand a brand. Really commitment to invest in systems and infrastructure and human capital, and through that really dramatically and prudently accelerate growth across the top and bottom lines.
Yeah, it's an interesting trend where we're seeing hold periods become longer as groups think through sustainable growth practices, whether that's investments into upfront infrastructure or taking, let's say, a combination approach of de novos and acquisitions to enact some of their investment goals and objectives. I'm curious to hear both of your perspectives on, what trends, strategies, sectors that we should be mindful of for, let's say new PE investment activity or accelerated PE investment activity through the end of the year, and just generally what your takeaways are on what the rest of 2021 has in store for us.
One sector we see accelerated consolidation in is cardiology. Recently, CMS approved additional CPT codes for an outpatient setting. So, procedures can now be done in ASC. So we're expecting to see an increased activity in cardiology. There are currently very few platforms out there, if any. So we're in the very early innings of consolidation there. I also think as we've seen a number of more mature platforms in the market now, there are a few that are going to be looking at secondary buyouts or transactions going forward, particularly in ophthalmology and in dermatology. We mentioned before that COVID kind of acted as a catalyst for a number of strategies, whether at the firm level, operational level, or from a private equity investment and sector specific focus. But, a lot of these groups today, just given how robust and hot the market is, there are a lot of platforms out there that are considering other strategic options and exploring sale processes now, which is why you're seeing an increased number of secondary buyouts or transactions occurring this year, and we'll likely see in the second half of this year before 2022 as well.
Yeah, I'm happy to chime in here too. I think, the outlook is, as we've discussed, I think throughout the podcast here, activity will remain high for the balance of 2021 in our view. And I think that's given the drivers on both the demand side as well as the supply side here. On the demand side, the investment firms and debt financing sources, after sitting on the sidelines for most of 2020, firms need to continue deploying capital in accretive growth opportunities. And that gives rise to competition in the marketplace, which, I think will continue to drive consistency in valuations as we've seen them more recently. They'll continue to be favorable for sellers. In addition, for sellers, I think the other thing driving the really supply side of deal activity in the marketplace is really around the new administration's proposed tax plan, which will take effect in 2022. I should say, which may take effect in 2022. The proposed increase in long-term capital gains tax rate is likely motivating sellers to go to market today and try to close transactions in 2021 ahead of the proposed increase going into effect next year. We don't know where this proposal will ultimately shake out yet or what the results will be, but we are seeing increased deal activity across the market and believe this is one contributing factor to just increased activity through the balance of 2021 here.
Yeah, that's a great point, Kyle. It's a point that's come up in a lot of our recent conversations, and the common question to us is, can we get something done before the end of the year? And I'm sure that's going to lead to an immense backlog for not only, bolt-on acquisitions that you may have for portfolio companies at WAD, but even thinking about, new investments, et cetera. So I'm sure it's going to be some level of balancing act, but again, we don't know what we don't know and kind of how ultimately those rates and everything would shake out. But I think generally from our perspective, it seems like some of these, general trends influencing consolidation and PE investment in healthcare services, whether that be push towards value-based care, improving internal infrastructure of these businesses to take on the growth available within their current markets, or simply seeing the benefits of size and scale through a roll-up strategy, continue to be key motivating factors, taxation or not. But it just, certainly seems that potential changes from a cap gains perspective has taken some element of acceleration to certain, shareholders' motivations and timelines for doing a transaction. So I think that's something that we'll definitely keep an eye on as time progresses throughout the rest of the year here. I think that was everything that we were hoping to touch on for this podcast. Kyle, we really appreciate you taking some time to speak with us here. We think that the content in this episode should be very helpful for our listeners in terms of hearing directly from a private equity investor how they're thinking about some of these recent trends within the healthcare services arena and what to expect in the future. If our listeners have any questions or would like to reach out to us directly, they can feel free to email us at podcasts@providenthp.com. And Kyle, appreciate your time again and look forward to our next episode here.
Thanks again, AJ. Appreciate you having me.